Tesla didn't slow down in January. What actually changed was the way the market looks at Tesla. That's the conclusion I want to start with today. If January left you feeling confused, the stock didn't really rally, didn't really crash, earnings looked weak, but the price didn't fall apart. This video is for you. In the next 10 minutes, I want to help you understand three things. Why January felt so unclear, what the market quietly started searching for beneath the headlines, and how long-term Tesla investors should reframe what they're watching in 2026. This isn't a news recap. This is about perspective. Hi, this is Ken. Today, I want to organize what actually happened to Tesla in January 2026, not day by day, not headline by headline, but structurally. Because January wasn't chaotic by accident, it was confusing for a reason. Let's start with how January felt to most investors. Tesla looked like it was about to move but didn't. It looked weak but refused to break down. Earnings came out, the stock sold off, and then it bounced. At the same time, the media split into two camps. One side said Tesla's growth story is over, margins are shrinking, EV competition is catching up, this is the ceiling. The other side said the exact opposite. This is a transition, a re-rating moment, the beginning of something bigger. If you felt stuck between those two narratives, that's completely normal. So here's the key question we need to ask. Did Tesla actually slow down in January? Or did our old way of evaluating Tesla stop working? That question changes everything. Now, let's take emotion out of it for a moment and look calmly at the price action. Yes, Tesla corrected in January, but this was not a panic market. Volume didn't explode. RSI never reached extreme oversold levels. There was no forced liquidation, no fear-driven collapse. The stock moved sideways, choppy, unstable, but not fearful. That matters, because when a stock truly breaks, the market doesn't hesitate. January was hesitation. And hesitation usually means one thing. The market is unsure what it should be valuing. This is where January becomes interesting. For years, Tesla was a very easy company to analyze. How many cars were delivered? What were the margins? Did price cuts increase demand? Those metrics worked. Good numbers, stock up. Bad numbers, stock down. But in recent months, that logic started failing, and January made it impossible to ignore. Earnings disappointed, but the stock didn't collapse. Positive news appeared, but the stock didn't instantly re-rate. That doesn't mean the market was confused. It means the market was transitioning. Investors weren't arguing about numbers. They were arguing about what Tesla is becoming. January wasn't Tesla losing direction. It was Tesla moving from one identity to another, and the market struggling to switch lenses fast enough. And this in-between phase is always the most uncomfortable time to invest. In the next part, I want to talk about what Tesla started showing in January, not in words, but in actions. Because once you connect those actions, January stops looking like slowdown and starts looking like preparation. So what exactly did Tesla start showing us in January? If you zoom out and connect the dots, one theme becomes very clear. Tesla stopped optimizing for how to sell cars and started reorganizing around how FSD is actually used. That shift explains almost everything that looked confusing. The changes to FSD pricing, the move away from one-time purchases, the emphasis on subscriptions. Individually, these headlines felt messy, but as a single strategy, they point in one direction. Tesla is moving FSD from a future promise to a present service. That matters more than most people realize. A one-time purchase model creates clean, upfront revenue, but it also means selling something that isn't fully finished yet. A subscription model does the opposite. You pay for what works today. If it doesn't fit your needs, you can leave. From a regulatory standpoint, from an insurance standpoint, and especially from a robotaxi standpoint, this is a far more realistic structure. In January, Tesla stepped clearly into that reality. The same mindset showed up in hardware decisions. HW3 will never perform like newer generations. That's not philosophy. That's physics. But Tesla didn't abandon it. Instead, they began redefining its role inside the fleet. This isn't a sell and forget company anymore. It's an operate and optimize company. And that distinction changes how long-term value is created. Then, in the second half of January, something else happened. Ideas started turning into evidence. Long-distance drives without intervention, robotaxi operations without constant supervision, and quietly, insurance companies began treating FSD as lower risk. Insurance doesn't care about hype, it cares about probabilities. When insurance pricing shifts, it signals that autonomy is being evaluated as a risk reduction system, not just a feature. That's a major threshold. At the same time, the conversation around robotaxis changed. Not is the tech possible, but how much does it cost per mile? Once cost per mile enters the discussion, the technology phase is already ending, and the business phase is beginning. This brings us to earnings. On paper, the numbers disappointed. Lower revenue, lower profit, the stock sold off. That reaction made sense at first, but then you look deeper. 1.1 million FSD subscribers, energy margins at 30%, and from Q1 2026, FSD fully shifting to a monthly model. The key question wasn't deliveries, it was structure. How does Tesla intend to generate profit going forward? And that's why the stock sold, but never collapsed. During the earnings call, the direction became even clearer. Model S and X production winding down, factories preparing for Optimus, Robotaxis already in deployment mode, massive investment plan for 2026, even semiconductor ambitions expanding. This wasn't short-term efficiency. It felt like Tesla deliberately stepping away from being defined as a car company. Media reactions split exactly along that line. If Tesla is an EV maker, this looked like slowdown. If Tesla is an AI and autonomy company, this looked like a transition point. That split was the January price action, sold on numbers, bought on narrative. So how should long-term investors see this? Before asking whether the stock goes up or down next, we need to answer one question honestly. Are you valuing Tesla as an EV manufacturer or as an AI company operating in the physical world? Because that single assumption changes how every headline feels. January wasn't Tesla slowing down, it was Tesla being redefined. The EV business is maturing. AI, autonomy, robotics, and infrastructure are just stepping onto the starting line. If you hold that perspective, February and all of 2026 will look very different. And that's the lens I'll be using as we move forward together. Before we wrap up, let me take a moment to introduce myself. I drive a Tesla Model Y, and at home, I've installed a Tesla Powerwall, so I actually charge my car with solar energy. I truly believe Tesla is shaping the future, and that's why I share the latest news and insights here on this channel. I'm from Japan, but I want to connect with Tesla fans all around the world. That's why I also create an English version of my videos. YouTube now lets you switch the audio into your own language, so you can enjoy it in whatever language you prefer. Most of all, I'd love to connect with Tesla fans everywhere so we can support Tesla together. I also share updates on X, so feel free to follow me there and let's connect. And if you haven't already, please subscribe to this channel. I'd really appreciate it. Thanks for watching, and I'll see you in the next video.